So let me just start off with a few brief introductions. All of our panelists, many accomplishments are listed on the event page, but this is sort of a dream team of reverse mortgages, which is not a phrase you hear very often, but this is, I think, the way I would describe this panel.
Only 4 people.
That's it. That's it, but it's still accurate. So to my left, we have Lori Goodman. Lori is Vice President at the Urban Institute and co-director of its Housing Finance Policy Center. She spent 3 decades as an analyst and research department manager on Wall Street. She's an expert on housing finance, including reverse mortgages, and she recently testified to Congress on this issue. Next, we have Chris Meyer. Chris is the Paul Milstein Professor of Real Estate Finance at Columbia University's School of Business. He's the co-director of the Paul Milstein Center for Real Estate. He's also the CEO of Longbridge Financial, which is a reverse mortgage company, and he is the director of the National Reverse Mortgage Lenders Association. Then, of course, we have Stephanie Moulton. Stephanie is an associate professor and director of doctoral studies at the John Glenn College of Public Affairs at Ohio State University, and she is widely published on reverse mortgages. We also have Tom Davidoff. Tom is the Stanley Hamilton. He has the Stanley Hamilton Professorship in Real Estate Finance. He's the director of the UBC Center for Urban Economics and Real Estate. And like Dr. Moulton, he is widely published on reverse mortgages. So let's just jump right in. Lori, let's start with you. Do you mind taking a few minutes and just reacting to, we'll start with Stephanie's proposal. What do you think?
So I love Stephanie's proposal. She just makes a lot of common sense recommendations to increase the reach of the reverse mortgage product. And not only does she make these recommendations, but she actually sizes the use of it. So she recognizes the fact that the reverse mortgage program is not for everyone, but then says, okay, there are 2 specific uses that are very, very common: small dollar HECMs and forward mortgage HECMs. Both make a ton of sense. On the small dollar HECMs, I see how you can squeeze out costs, reduce insurance costs. You could do things like waive appraisals and use AVMs instead with the loan-to-value ratio that's that low. With forward mortgage HECMs, I have a little bit more trouble seeing exactly how you would streamline the process, but conceptually, I love the idea. In terms of implementing risk-based underwriting and preventative servicing, the risk-based underwriting, again, very, very logical. FICO greater than 680. No underwriting. FICO less than 680. Automatic LISA with an opt-out if you pass the financial assessment. Makes a ton of sense. On servicing, reminders to pay property taxes. Again, who can disagree with that? And then she also makes some suggestions in terms of cash for keys. Right now, you can pay up to $3,000 to a borrower to exit the home, but only if it's a 2017 HECM or later. She says, well, why not extend to earlier borrowers? I think I would take that even further and say, why limit it to $3,000? Why not in long foreclosure states limit it? Why not have substantially higher numbers? It's a very, very graceful exit all around. So in short, I really thought this was a lot of very common sense suggestions and wholeheartedly endorse the paper.
Chris?
So I basically agree with where Lori is in this. Stephanie and her co-author, Don Howard, have been longtime researchers in this program, and Stephanie brings an expertise of really, really understanding the program and how mortgages work, and previous work at a housing counseling agency. I think some of her work in talking about servicing brings a very practical element to it from somebody who really understands the business. I'll say a couple things. I think Stephanie is really focused on the low moderate income market. I think that it is clear there are a large number of seniors who are relatively house rich and cash poor, and the question is, can they responsibly access their home equity using a program that I think is likeliest to be provided by the government, because this is a demographic that is relatively expensive to serve with relatively low home values. And there have been research that looks at home prices and what's happened to the collateral value for these folks. And unfortunately, these are people whose homes don't generally appreciate as much as the rest of the population. And so it's a kind of market that I think would have a hard time existing absent the government. And the critical thing is try and figure out how can you serve this market without a large cost to taxpayers, although I think this is a market taxpayers should look at the benefits of helping people stay in their home longer in terms of the healthcare system and in terms of the stability of their financial situation. There are other sort of demographics and markets within this for people who have, higher home values, higher incomes, and still face problems with healthcare at home, retrofitting their home. And so there are other markets beyond what Stephanie's identified. And so I think there are many people for whom using the liquidity of their home can be a benefit.
And Chris, when you say a market is expensive to serve, what do you mean?
The collateral values don't hold their value very well, and this is a demographic that has challenges in terms of their ability to live well and meet their obligations. And I think financial assessment can help, but part of the social purpose of the program, which is helping people have a better retirement and stay in their homes longer in this demographic, is expensive. These are people who are nervous. Explaining, selling, helping them understand what the program is about is a very time-consuming process, and the dollars involved from a lender's perspective are not huge.
Yeah.
So I think there is a value to doing this. It's a place where the government needs to play a strong role in ensuring that people are, appropriately, products are appropriately managed, sold in a way that's responsible. But it's also a market that I think wouldn't exist at this, for some of these folks absent the government involvement in something like a HECM. So that's the cost challenge. I would also say one other thing on Stephanie's comment, and I'll wrap up on the rolling a traditional mortgage into a reverse mortgage. We can talk more about this, but the UK has a market that is essentially per capita 6 or 7 times as large as the US. And the major insight in the UK that I think would be helpful for us to understand is that a 30-year fixed rate or a long-term mortgage with payments for somebody in their 50s or 60s, that they're going to be paying for another 30 years without a pension system, is not clearly an appropriate product for many people. And it puts them in a situation where they're making payments in retirement that they then have to struggle with. So some way of creating a product that serves those folks, that allows them to make payments for a period of time and then roll into a reverse or take out a traditional mortgage and roll it into a reverse, that allows them at some point to stop making payments. And a lot of these folks have loan-to-value ratios where this would be a workable product, is something that I think has a lot of potential, and it's something that's driving the growth in the UK market, because the government has said you can't put somebody in a financial product which is sort of setting them up to fail. And a program where you can make the payments today, but you can't make the payments 5 or 10 years from now, is viewed as a program which is setting people up to fail.
Yeah.
So I do think this issue about how to transition people responsibly, it's got to have counseling, it's got to have things explained to borrowers, has a lot of potential to think about, although the logistics, as Lori said, I think will take some work.
So Tom's proposal, well-informed, like Stephanie's, but very different. Lori, what'd you think of what Tom had to say?
So first of all, I thought it was just incredibly clever. I thought, that the annuity cash flows essentially provide a hedge for the reverse mortgage instruments. But then what I worried about is first that it would have a detrimental impact on the number of reverse mortgage borrowers, because essentially you're requiring a borrower to make 2 decisions. You're requiring them to essentially decide to buy an annuity plus the reverse mortgage. And so I'm thinking about it, well, if I die 2 minutes after I take out my reverse mortgage and annuity, I essentially lose the value of the annuity. So I have to make the decision to do both. In addition, the idea, again, is very clever. It doesn't directly help the borrower, although it might do so through lower payments through through more favorable pricing, as Tom points out in his paper. But it's really a hedge for the lender. And I wondered if there was any way for the lender to set up a fund that essentially pools reverse mortgages with an annuity. So you essentially have the lender who is benefiting the most from this sort of create the hedge themselves. And I will leave it to you, who is far more clever than I, to figure out exactly how that could be implemented. But I actually thought that might be a really cool idea for a fund. This also, the third point about this paper is it abstracts from any default risk on the part of the annuity provider. So it's less useful in the U.S. where the government essentially provides that insurance. Why would the government then take out an annuity on somebody's life when that annuity provider might not actually be there? But again, I thought this was just incredibly clever, and I wondered if there was some way for the lender to take the risk and get the benefit.
Chris, what do you think?
So first, I agree with Lori also. I think it's a very interesting and creative idea, Tom. I will go further than that and essentially say this is an idea that actually in practice is happening. But it's happening at the pool level, and it's happening as people are already financing private label reverse mortgages. So in essence, what Tom is suggesting is basically break a reverse mortgage into, or the cash flows into two parts. Take a lower LTV piece, which should have a higher, which should be safer and have a lower yield associated with it, and finance that with relatively low cost capital. And then you have this residual piece, which is essentially the annuitization, and finance that with higher cost capital for people who are, funding annuities. And that's actually essentially how private label loans are done, but they're done in a pool where you have payments that occur over time and pay down the balance. And so you securitize essentially the first 7 years of payments at a relatively low cost of capital. And then the remaining payments are at a higher cost of capital. The big difference, and the thing that is not working as well today in the private label side, at least in the US and again in the UK, and elsewhere, at least in some other countries, what you see is the right people to be lending on reverse mortgages are actually insurance companies or pension funds, because they have very long-lived capital, and that idea of sort of essentially getting payments that are going to last a very long time should be coming from people who that offsets their liabilities. So you don't need to do it in an annuity if what's happening is that capital is getting directly provided by somebody who's willing to take that risk on their balance sheet and essentially take the other part, and then you don't have the default risk associated with the annuity as well. That's not happening in the US because at the moment it's sort of hedge funds or private equity funded vehicles that have a very high cost of capital that are funding that sort of long-lived risk piece. And it turns out if you discount that at 15%, you don't get a lot of value, and so that's a flaw right now in kind of how the U.S. has done this, but other countries have, done this well, and frankly, you don't have to tranche it out. If you're a insurance company or a pension fund, you're perfectly happy getting sort of a set of payments over a long period of time, even in kind of a whole loan context. So I apologize, that was like probably too high a level comment for, a bunch of the kind of the policy piece, but it's a way of basically saying, I think the idea Tom is talking about makes a lot of sense, and it's something that people who are looking at financing these things are doing today in some variation of the approach.
So Tom and Stephanie, do you want to take a crack at responding to any of this, and we'll jump into some other questions? But so Tom, do you have any thoughts on these?
Well, first of all, let me just say I completely agree with the small value. To the extent there are borrowers who want small value loans, a low fee, HECM saver type product just makes a tremendous amount of sense. And on the forward side, at qualification, right, you could think about doing all the screening at the date of qualification, and that would make the loan cheaper at origination if you say, we're going to provide you this option to roll over, or in fact, should you miss a payment or 2 or 3 payments, we're going to immediately transition you to this at a certain age. There's got to be economies of scale of doing 2 originations at once. So I think, not surprisingly, your ideas are excellent. On Chris and Lori's point, I originally presented this to a group as something yet even, considerably more convoluted. And the idea was to actually take the HECM mortgage-backed security and take a lower-end tranche and give the essentially make the annuity a claim on that the borrowers would get. So essentially, what the annuity that would be going first to the lender and then the borrower when they move would be a junior tranche of a reverse mortgage with almost a tontine that the last one standing would get a giant payoff to match the giant liability of loan versus product. The other point is I agree, the double sale is going to be very hard. To the extent there's value in the proposal, I think it's just to clarify, what the sources of value are, and to say we should think about this annuity that lasts as long as the borrower is in the home. That's one part of risk, and it can be used to somehow avoid crossover. How you exactly implement it, I'll leave to the very capable hands of Wall Street and Harlem.
Yeah.
Stephanie, any
Yeah,
reactions?
sure. Some quick thoughts. I mean, I think it was interesting reading Tom's proposal. We're both kind of thinking about crossover risk and different ways of going about crossover risk, more incremental, and I think yours is much more kind of fundamentally transforming the market, although, as Chris says, maybe it's happening anyways. But I think that's I really appreciated that. And to the comment about, I don't think the HECM is designed for everybody, and I think, or should be designed for everybody. I think we need both a private market and a HECM market. And you asked a question, Ben, about what is the additional risk of serving these individuals. And I think there's somewhat of a misnomer. So actually about 75% of HECM borrowers have a credit score of 680 or above. So like this idea of having a threshold of 680, these aren't, even though a lot of them are lower income, so this idea that they are house rich, cash poor of the current HECM borrower population is still true. We do find that in general they have very low levels of financial assets and higher home values, but that doesn't mean that they're poor credit individuals. So only 25% of them actually have credit scores below 680. But it's those 25% that we have to really worry about. And I think it's those 25% that are potentially going to struggle, that we have to really design a product that's going to be made so that they can succeed, to Chris's point. Like, so whether it's a default lease or whatever we do to kind of make sure we protect those individuals, I think that's critical. And then also the information asymmetries in the market potentially. So higher wealth borrowers may be more sophisticated, have access to financial planning. Lower wealth borrowers often don't have those resources. And so there's the potential to be taken advantage of, or they have less information than others. And so I think the government's role in this market for those lower wealth borrowers is also because of the kind of potential for information asymmetry, where the borrower knows less than the lender. And so making sure that we design products that can be safe for those individuals.
So we'll turn to a few more questions more broadly about reverse mortgages. Can I just stop and for 1 second though and say, I find this incredibly complex. So I usually study taxes. Reverse mortgages blow taxes away on complexity. Both the details of the particular loans, how the programs work, the reforms that have happened. You saw Stephanie's chart up there. I mean, this is a program which is transforming before our very eyes almost every year. I find it really confusing, and that's before you even get to the economics and everything that Tom's talking about. This is an incredibly complex issue. So maybe we can just acknowledge that from the get-go. If you're interested in learning more about it, I encourage you to go to the papers, both the framing paper that Martin and I put out, and also the framing that are part of both Stephanie's and Don's and Tom's paper. So I encourage you to read that if you're confused. We have a quick question in the back. Is it related to what I just said? Yeah. Oh, yeah. So we're going to have questions at the end. Do you mind holding it for 15 minutes or so? So Lori, could we just talk more broadly? So we heard Deb Whitman come up during her keynote and talk about retirement security and all the challenges that are included in that. More broadly, should we be looking at home equity as a solution to our retirement challenge, or is that not a first-order concern?
No, I mean, I think Deb did a great job of talking about how retirement savings is challenged. And I'm just going to get sort of 43% of seniors would have incomes below the poverty line were it not for Social Security. I mean, home equity is their major asset, but people don't think about it as a retirement tool. A Fannie Mae National Housing Survey in 2016 found 80% of homeowners 55 and over were not at all interested in borrowing from home equity in retirement. They view it as a tool for those in really bad shape, and well, that's not me. Retirement planning has historically only included financial wealth and not housing wealth, even though most people have more of their assets and housing wealth than in financial assets. Financial advisors and planners aren't trained in and don't know much about products that allow the client to tap into home equity, which makes them reluctant to endorse these types of products. In addition, as Shelley has stressed over and over again, financial advisors can't be legally compensated for recommending reverse products because RESPA, the Real Estate Settlement Procedures Act, prohibits people without a mortgage license from being paid on a mortgage transaction. So even if a financial advisor knew about reverse mortgages, it wouldn't make sense for them to take the risk that someone uses a client's home equity inappropriately when there's no compensation whatsoever to them. Now, addressing this is really complicated. We certainly don't want financial planners getting compensated to put seniors into inappropriate products. On the other hand, you do want tapping into home equity to be included in financial planning, and so perhaps including it in the certification procedures and putting rules into place as to what a financial planner can and can't say, and limiting compensation would be very advantageous to the consumer. It makes no sense to think about planning for retirement without thinking about how to use what is the largest asset for most retirees, which is their home. That is, you really want to think holistically about retirement. Reverse mortgages could be an alternative to selling stocks in a bad market. It could be way more favorable than incurring penalties on withdrawing assets from individual retirement accounts. If an older adult is selling one home and buying another, financing the new home partially with a reverse mortgage can free up cash for daily living expenses. Moreover, the more homeowners know about the options, the less susceptible they are to scams. In addition, reverse mortgages can actually work very favorably with Social Security benefits to improve financial security. So a person who would elect to early Social Security benefits, if they tapped into home equity at age 62 and later elected a later Social Security draw, they could be better off in the long run. So sort of ignoring that holistic approach to retirement and ignoring your major financial asset makes no sense from a retirement planning point of view. I just want to make one last point, and that's that many lower income, home rich, financial asset poor people don't use financial planners, and we need to improve reverse mortgage counseling as well. So currently, counseling is by an independent third-party counselor approved by HUD, and it has to be completed before a lender processes a reverse mortgage application. The counseling includes information on how reverse mortgages work, payment options, benefits and drawbacks, and tax implications. But the counseling happens late in the process, after the homeowner has decided to obtain a reverse mortgage. Mandatory counseling could be enhanced by requiring lenders to refer borrowers to HECM counseling as their first step after initial contact. In addition, and this is an idea I stole from Stephanie a long time ago, and I've repeated more times than she has, is that counseling could be targeted for different types of borrowers. That is, borrowers could be set down several tracks depending on their creditworthiness, needs, and assets. For example, a borrower with a high credit score and significant household wealth may be better suited for a forward home equity product such as a HELOC. And these borrowers might be better off looking at comparing a reverse mortgage to a HELOC. On the other hand, lower income borrowers with limited means could benefit from counseling that focuses on more appropriate use of HECMs and how to select the right amount to borrow. So a few different counseling tracks would make the counseling more valuable to a diverse customer base.
Thanks, Lori. So Tom, I think it's only it's not exaggeration to say you've written more about the issue of reverse mortgages as a hedge against longevity and falling home prices than anyone on the planet. You've written about it mostly in academic papers, as far as I can tell. Should consumers be thinking about reverse mortgages as a hedge against longevity and falling home prices more? Should we see this in the Wall Street Journal regularly? Should this be just sort of part of the consumer experience?
Yeah, I was wondering if only there was someone in the federal government who had a lot of credibility with seniors, who could convince people that borrowing more money than in some cases you pay back can be a good idea. but I just can't think of any individuals in the federal government who might be able to play that role. It is a difficult sell without the salesmanship of a Donald Trump. I think, getting people to think the idea, well, I'm going to borrow more than I think they think it's unethical. There might be, I don't know the credit score impacts, honestly. I've tried to figure them out. It's a little bit opaque. But yes, I mean, if you think about Sun City in 2006, when you had this large excess valuation in the Phoenix housing market, and you have a product where you don't have to even borrow any money because the line of credit grows at the reverse mortgage interest rate. So you get a line of credit, which back then could be more than 60% of the value of an overinflated home, growing at a spread of something like a 2% over the riskless rate. The likelihood that that line of credit, if either prices fell dramatically and or you lived a long time, grew to be more than the value of the house, you could pay 6% of the value of the house for the option that should it ever come to be the case that that credit line grew to be more than the house, that would be incredible insurance against a price decline or longevity that would have been worth much more by any calculation than 6%. So you're insuring two very hard to insure events, price decline and longevity, that are phenomenally important in the portfolio of a senior. If we were all AI bots, this thing would have been selling like hotcakes because it's great insurance. But, the marketing, I think, is a real challenge. Not calling it underwater on a mortgage, maybe relabeling somehow. But it's potentially really great insurance, and with diversification, it could be a great, great market. I just want to say one thing about the concerns about unscrupulous lending, which I totally agree with. I just think in the current environment, if I can just take a step away from risks to macro, if we really live in a world, especially in coastal markets or DC, San Francisco, Vancouver, where I'm from, rents are going to grow at more than inflation. I think they just are. As the world gets less stable, you have 200 million Americans who may need to move to Canada pretty soon. You've got climate, what have you, China. Growth in supply-constrained cities of rents, it's not going to be inflation. It's going to be more than inflation. So you're looking at 2.5%, 3% a year. And riskless rates, as far as I can tell, I think people on Wall Street think they're going to be 2% forever. If you have riskless rates that are really, really low and rent growth that's high, it turns out the value of a home, which is sort of the rents coming from the home forever, the fraction of that value that is the rents during a senior's remaining lifetime gets really small. And the value after, which is what a reverse mortgage really can provide, gets very large. So should current conditions persist, we have to use home equity to fund retirement. There's no way. The other side, though, is the beginning of life. There's no way that in somebody's working years, they're going to be able to pay the true value of, say, a single detached home with land. No way, because 30 years of work is going to be very small relative to the value of rents coming out of that house from today to infinity. And so I think we have to get more creative about mortgage finance. The 30-year mortgage makes sense in a 14% interest rate environment where home prices don't grow because there's plenty of new supply. But I think in our current macro system, we really have to rethink housing finance, and especially that means at the beginning and the end of life.
Stephanie, so I think if you look at, well, my interpretation is if you look at a lot of the reforms in this market over the past 7 or 8 years, they're driven by fiscal concerns, right? So concerns that this was just too expensive. Well, it's expensive. It's supposed to be have no net cost to federal government. How does that conflict with the desire to make this a broad-based program, to have broad coverage, to have this available to a wide swath of seniors who might want it in a lot of different circumstances? So basically, how does expanded coverage conflict with the desire to have a low-cost program?
Yeah, and I think we have to worry about both of those things. I think some of the problems that we have, the fiscal constraints the concerns that we have are legacy concerns. I mean, I do think, and this is a challenge, to kind of make sure that we don't ignore the legacy HECMs that were originated before a lot of the good policy changes have been put into place, while at the same time building product options that are actually appealing to individuals and not penalizing the future seniors for kind of sins of the past, so to speak. So there's kind of two things to balance there. And I think, there's ways to address the fiscal concerns while still allowing for expansion of the market. And that's what we were trying to think about in some of our proposals, was how can we address some of these fiscal concerns. One of the big fiscal concerns, it results when after the home is assigned to HUD, for example, or when the home goes through a foreclosure process. I think it was the CBO that estimated that I think 25% of the home's value is lost through the disposition of the HECM. So what that means is that because after the home has been assigned to HUD, or a servicer is processing it through a foreclosure process, it takes a long time. They add costs to that. They have to maintain the property, and they actually end up selling it at a huge discount than what they would if it was just a third-party sale. So what seems like a little thing like that, if we can maximize that value, then that'll help keep the insurance fund from being in the red, so to speak. And so that addresses some of the fiscal concerns, which then allows us to kind of think more creatively about the front end of the product. So I think we have to address both the back end and the front end. We can't just do one without the other. But I think some of the current concerns, the $14 billion that you recently cited with the actuarial report, is real, but it's also an actuarial report. So it's a projection based on what house values are going to do, and also based on the legacy book of business. And the future book of business is probably going to perform better than that. So I think there's this challenge of not letting ourselves get so concerned about kind of shoring that up that we don't think about how to create innovative product options that are going to help address future needs as well. So there's definitely a balance to strike there. And I do think some of the, streamlined underwriting, thinking about the risk of borrowers and how do we address the underlying risk of individuals. The forward market has known this for decades, that we can use underwriting to help address risk. And I think it's time that we think about that in a smarter way. The financial assessment is certainly a step, but it's very manual. And if we want to bring this to scale, if we want to bring the big lenders back in, if we want reputation risk to go away, part of that is bringing in big players again to the market. Then I think that's going to require more automated processes and not this very manual process that we have currently. So.
Thank you. So Chris, let me ask you a question. When I mention to people, mainly economists, because that's who I talk to, that Martin and I were putting on this event, and I would say sort of the modal response is an eye roll. And say, a reverse mortgage those are sold at 3 a.m. by some huckster. So so let's just let me just ask you, what do you think about reputational concerns in this market? Are they outdated in light of recent reforms? Is the eye roll fair?
So the first thing is, when you look around the world, you actually hear the same comments in many, many countries with very different structures. So as Americans, we're always used to understanding kind of how we look at the world. But you could travel to Spain. You could travel. I literally did a retirement conference in Spain last December, and was asked by their sort of top business magazine. They did this whole Sunday section on U.S. Expert comes and talks about reverse mortgages, and one of the questions was basically about a U.S. Netflix show that had a comment about an aging actor who decided, I'm never going to do a reverse mortgage ad because it's crazy. So that's in Spain. You could go to Australia, you can go to the UK, same sets of questions. So there's something more about this than how we've managed the HECM program in the US. I think some of it has to do with serving a protected class, which is a vulnerable class, and the concerns associated with that. I think some of it has to do with how we've designed and built the program, which is imposing risk on seniors that I think is completely unnecessary and shouldn't be the case. So we should really be designing a program, when you talk to folks in the UK where they've started to get around the reputation issue, they just laugh at the idea that the enforcement of a contract should be to foreclose on a senior. There are better ways to design and build programs that don't leave seniors at risk of losing their homes, and to underwrite and design around those things. So some of what Stephanie's talking about is managing risk at the front end, and some of it is sort of managing the challenges that people have in meeting their obligations and staying, able to maintain the home. And so you have to take on those issues if you want to think about designing a program that's, responsible. I will sort of say the AARP has done a really good job of standing up in cases for seniors where, the HECM program was just designed in ways that was, I'll say is unfortunate. And I think that idea that there's non-borrowing spouses even allowed and not underwritten into the program, where somebody could, pull their, it's almost always wife off the deed. The wife is younger. We can qualify for more money. And then, the husband dies and the wife then faces the loss of the home. So these are just all things about how you design a program that I think we really, many of which we fixed, not all of which, some of which can be designed by better servicing. But they're things that modern financial products shouldn't have as attributes. So I think some of it is American, some of it is the perception of the product. In the UK, you have Legal & General, who's one of the largest insurance companies who came into the business at some point. And I would be surprised if we don't see, we have Mutual of Omaha is the closest we have to a brand name company. I think we're going to see more of them come in because this is an important market and demographic. And as we find ways to deal with it responsibly, we're going to see more folks get in. Two other observations. One of them, I think Lori's comment, it really is impossible if you're a financial advisor to ignore the home and believe you're giving somebody credible advice about retirement. It just is. You have to get up to the 90th percentile of the wealth distribution before home equity isn't the largest single asset that people have. And, not counting the present value of Social Security and pensions.
Yeah.
And to ignore that and think that you're giving somebody credible advice is just really hard. And whether that's a fiduciary duty, whether it's sort of some kind of other duty to serve, the idea that you can look at somebody, sort of look and say, well, you've got mortgage payments to make, but I'm not going to think about how you might deal with those, just strikes me as you're not really providing the kind of advice you should be providing. And I think most advisors know this. But we haven't yet gotten around to a position where they can talk about it. The last thing is, I think, on the complexity of the product should not be this complex. If you think about a standard HACM line of credit product, what is it? It's a product where you are guaranteed an amount of money that you can borrow. You can make payments if you want. You can not make payments if you want. It's basically sort of like a safer version of HELOC, which you also have to make property taxes and insurance. Start with the fact that I think we should deal with that issue better than we have, or reserve some portion of the HELOC to cover that with ELISA. But it's actually not a terribly complicated product. And I think we've made it more complicated than needs to be. I think maybe we should have fewer options for people to convert back and forth with plans, to have to look at different kinds of products, to show consumers different kinds of products, which are very different. Maybe we should have sort of one standard line of credit product. You can't take all the money out up front. And I really think for most seniors, the surveys show this and the data show this. The reason people don't want to annuitize, I think, is because annuitizing is not meet the kinds of financial obligations people really have. When you're older, your expenses are not, I have X dollars a month, X dollars a month, X dollars a month. Social Security or some kind of other draws will cover that. They're lumpy things. I got to fix my house. I want to, take a family vacation, with the grandkids. I want to help out. I just got put in the hospital and I need 3 months of at-home care, to deal with my broken hip. They tend to be lumpy, irregular kinds of payments where having a line of credit substantially helps their ability to meet those obligations. And I think having a base of Social Security with a line of credit to help is, for most people, the right solution. And I think if we thought about the product and helped people understand the product and had disclosures and, counseling around that idea, and we figure out, ensure ways to make the product safe for people not to face foreclosure, that to me seems like a path forward for a product that should be much more mainstream and responsible than it is today. It's not an irresponsible product today, but it's a product that can be and should be better. And I think those are the kinds of things that will help grow the market. I'm an optimist. I sort of believe we're headed there. I think the government has slowly but surely made progress, and I think we're going to see private label products come out that are non-government products that are going to address those needs. But as you do, the question that Stephanie has raised, which is the government, where in the market is this? Is the government at everything? Is it up to 727, which is a very high, home price for taxpayers to be involved with the program. Right now, they're cross subsidies. Presumably, people with homes over $300,000 or $400,000 are actually subsidizing people with lower home values. So if you lower that limit, you're actually going to put the program in financially dicier terms. Just like most other FHA programs, you have cross subsidies going on. So the high-end homes right now are subsidizing the lower-end homes. So if you lower that limit and open up the market, you're then actually going to make it harder or more expensive for taxpayers to serve the other market I talked about earlier. So tons of issues, but I think there are lots of ways to address them, and I do think we are generally moving in a direction where I expect us to continue to make progress, both with the government and in the private sector.
So let me ask one more question, and we'll turn it up to the audience. If we do see, Chris, if you're right, if we do see an expansion in this market, we're going to have to deal with the foreclosure issue. And both proposals address that. But can I ask a few, just to the four of you, a sort of clarifying question around foreclosures? The first is foreclosures. So foreclosures happen when an older American can't make the property tax or home insurance payments. Is that person better or worse off with the reverse mortgage? So if they can't make the payments with the reverse mortgage, were they going to be able to make the payments without one? That's the first question. The second question is GAO had a report where they sort of explained what was happening with foreclosures, and they said that the majority of people who were foreclosing were not foreclosed upon because they weren't making the payments, but because they weren't physically in the house.
Right.
So do we have this sort of fundamental misunderstanding of what foreclosure means in practice for the bulk of borrowers?
Yeah.
Just to the, Stephanie, you want to start?
I'll speak to that. I mean, so I think the tax and insurance default issue has got a lot of headlines, and actually very few of those end in foreclosure. Getting the exact proportion that end in foreclosure, it's a tough stat to nail down. It's like Jell-O to the wall, but it is a very small proportion. The majority of foreclosures for reverse mortgages are actually when the person is at the end of life. So, and some of the recent reports show this, the actuarial report will show this, that it's when an individual reaches the end of their life and they're in a crossover situation, they put the loan back to HUD or the lender. The heirs aren't responsible for any negative equity, and then the lender will process that, or HUD will process that, the FHA servicer will process that through a foreclosure process, and that's just seen as a natural end of life to the reverse mortgage. The challenge is that, again, this is why we want to get rid of the crossover. When a home goes through the foreclosure process, even though that's a normal process for a HECM in many situations, it's costly because homes that sell through a foreclosure process sell for a big discount relative to homes that sell in the market generally. So that just adds to this insurance fund deficit. So one, it's costly. Two, it's headline risk. I mean, anytime, even if HUD's the one going through the foreclosure process, even if an individual isn't being put out of their home, so there's like eviction-related foreclosures, which are actually quite rare in the reverse mortgage world, versus this natural foreclosure that happens when the individual passes away. Even then, it's a foreclosure, and HUD is kind of the one behind that foreclosure, and so it creates a headline risk to the program that you're foreclosing on a home in the neighborhood, and then the evictions-related foreclosures do occur, but it's not as common as we might think. And in fact, it was in 2011 that HUD clarified that lenders even needed to pursue a foreclosure for individuals that were default on their taxes and insurance. Prior to that, there was some just kind of fronting the balance, the past due tax and insurance balance, adding it to the loan. The problem is then that you're increasing the growth of the balance, and that could grow indefinitely if you don't foreclose, and then you're exacerbating this crossover risk as well. So it's kind of, damned if you do, damned if you don't. Because that if you don't pay it, then the individual could face foreclosure. You have to kick them out. But on the other hand, if you just continue to pay it, the balance continues to grow. But I think that foreclosure is misunderstood in the reverse mortgage world because we think about it like a forward mortgage foreclosure, and it's very different. Many of them are this natural end process that I was mentioning.
Yeah, so Stephanie's done some amazing work on tax and insurance default, which is, how could you default on a reverse mortgage? You don't have to make any payments, but you do have to pay property taxes and insurance. And then your question is a good one. Should you be offering a product to somebody who's so on the edge that even after they take this reverse mortgage and give themselves some liquidity, they still can't make tax and insurance payments? And that's an interesting question. I think it highlights, why you don't annuitize the payments, going to Chris's point, and maybe to put it a little bit differently, a lot of lower income, up to 50th percentile would be lower income. Probably what many of us would think is lower income would be up to the 75th percentile of retirees. Who doesn't have a relative who needs to go through drug rehab somewhere in the extended family, or a relative paying 18% credit card debt? or some relative with a giant leak or some kind of structural problem with the house that they're going to have a hard time financing. So extended families that are realistic families, somebody has a project that's essentially an 18% rate of return project that's going to get financed one way or the other. And it could be a lot less savory than a federally guaranteed reverse mortgage. So these families in financial trouble, the ability to borrow at 4 or 5% interest is another benefit that I think people don't understand. They think, oh, well, this is bad for the kids. It's a fantasy for the kids that grandma's now going to have the ability to finance these really high-value projects, because I suspect a lot of them are family-related. It's a real opportunity, and without HECM, I don't know where the money would come from. So the counterfactual, there may be unsavory practices, but there's probably unsavory practices in that other finance world as well.
I would say one other thing. Foreclosure is simply the worst way to manage a problem under every circumstance. It's bad for the lender. It's bad for whoever it is, whether it's an estate. Well, it's obviously bad for a borrower than their home. And so finding more cost-effective ways to deal with it, cash for keys, other kinds of things, is just sort of an obvious thing. It saves taxpayers literally billions of dollars in this program, and it's the kind of thing that people should virtually never, bump into as a solution to a problem. And it creates headline problems. It's just designing a program around that makes incredibly little sense. And there are reforms taking place and more that need to, that I think that are being considered that will help with that.
Let me just say one last thing, and that is that, I think the issue with non-borrowing spouses certainly got a lot of publicity where, people took out more money than they would have otherwise been able to if they didn't include their spouse. The spouse is now required to be included for when you apply for a HECM, even if they are not on the HECM. And if the borrower dies, obviously the non-borrowing spouse can remain in the house. I think the one thing that still needs to be fixed is when the borrowing spouse is disabled and moves out of the house, leaving the non-borrowing spouse in the house. That's the one little, that's the one, actually not little, but that's the one issue that I think still needs to be addressed.
Thank you. Good point. All right, let's turn to questions. Let's start in the back over here, please.
Thank you. Sorry I jumped up so eagerly before, but I heard the complexity and low income. So I'm Carl Polzer, and I have two interests. One is I co-chair a group that for many years we call the Long-Term Care Discussion Group. We talk about all kinds of policy issues in a nonpartisan way here. The other is I have a project that looks at inequality and especially tries to advocate for the people at the bottom. So both my questions have to do with the complexity issue, and so with this population, it's really vulnerable because there's not just an asymmetry of information, there's an asymmetry of cognition. So a lot of times people are moving out of their house after a traumatic event like a stroke or onset of Alzheimer's. So 40% of the population of assisted living has Alzheimer's or other dementia, and 55% nursing homes. So that's why I think there's always a lot with financial products, a lot of hemming and hawing about giving them, I'm glad you said the word fiduciary. You sort of elevated to that level. I think there should be a fiduciary duty required, and I think that especially people with low income and low wealth should get automatic government-assisted financial advice, and there should be insurance that protects the elder from fiduciary malpractice or negligence in some way. So, and I like the British. So the other question I have with regard to complexity has to do with the annuitization. It's something I'm working on right now, how divergence in lifespans is an issue for Social Security, right? With Deaton and Case's work and Chetty and all that stuff. So my concern there for the lower income would be if they're pulled in with the rich guys, because you hit the winners. The winners are going to be the people that live a long time. The rich are now living longer and longer and longer, and the lower income, the lower quintile hasn't gained any lifespan since Social Security was created, according to the National Academy for Sciences. So that's going to affect their payoff a lot, whether they're pooled separately or pooled together. So I just threw that in.
So what do you guys think?
Yeah, no, I mean, I think the idea of the individual being more vulnerable is spot on. And I think, it isn't just information asymmetry, to your point. There's also cognitive decline in older age. There's lots of reasons why. And this is, like Lori and I have talked about, the customized counseling. How do we think about it beyond just an information packet, but something that's actually more tailored to the individual, and actually that maybe extends post-purchase. So, thinking about individuals on the back end, we tried offering actually in the experiment where we did reminders. We had 1,000 individuals. We randomized to get reminders. We had 1,000 that we randomized to get free financial counseling. And we tried to not call it counseling. And these were already reverse mortgage borrowers. I can count on my hand the number that took it up, unfortunately. But we thought, yes, they need financial planning. They need more. And these are individuals that already have reverse mortgages. And now they're going to want to have help, figuring out how to navigate that. And it was really hard to get people to take that up. So I think, how do we bake that in from the front end so that it kind of sticks with the life of loan? We've talked about life of loan type products that it's not just a one shot, here's information, but actually with the person.
And actually, let me pick up a point Chris made earlier, the very good point about simplifying the product.
Yeah.
This product is just, as he mentioned, so complicated. When you go in to get a forward mortgage, do you want a fixed or adjustable rate mortgage? And what kind of mortgage term do you want, 15 or 30 years? That's it. You go in for a reverse mortgage. Do you want fixed or adjustable? What kind of, do you want a lump sum disbursement, line of credit, term annuity, 10-year annuity? Oh, by the way, you can have any combination of these. Choose your ice cream flavor. And then also the timing and pace at which funds are going to be withdrawn. It's just such a complicated, program. I would actually just basically get rid of the annuity option entirely, because only about 6% of borrowers took advantage of it. 2% of borrowers opted for a term or 10-year annuity, and another 4% opted to combine that with a line of credit. So just get rid of that, and then on the line of credit, put a 10-year restriction. So you can have your payment up front. You can do a line of credit. You can do a combination of both, and your line of credit is good for 10 years. That way, it's a much, much simpler product. And actually, what I've described is exactly the proprietary product as I understand it.
Yeah.
And so one thing that, we could argue about, government products versus proprietary products, but one thing that proprietary products do is they're much more innovative. They basically are very quick to spot, this is what people use, this is why we use it, and this is what we're going to offer. And so sort of taking some lessons from that product might be very valuable.
Right. I'll just add two quick things. The first is you identified a critical point of ex ante versus ex post risk, which is to say people, when you price and create a product, you can put people in a solution that is workable at the time, but if they have something bad happen to them, some percentage of them will eventually end up with problems. You have to underwrite it to deal with that. But just because some people end up in financial problems with the product does not mean there was a problem with the product. It may mean that 80% of the people it worked fine, 20% it didn't, and you have to deal with that kind of, how do you manage that risk after the fact? But it doesn't mean that the product or what they chose was inappropriate at the time they did it. The second is that your point about shorter life expectancy is a really critical thing, because it's an offsetting trade-off of serving the low, moderate income households. The fact that they have a shorter life expectancy makes the product financially easier to offer because there's lower crossover risk. The product has a shorter duration. I think that's something that I haven't seen written up systematically in any research, and I think it is well worth looking at that question, because I think it would cut towards making it more financially viable to serve the LMI demographic. So I think that's a great point to bring to the table.
Do we have, yes, over here, please. She's going right here.
Okay. Hi. Yeah, my name is John Polner. I used to be at the World Bank in the financial sector. Yeah, there are indeed some pretty complex things in this product. I had a question on the annuity, proposal that Tom mentioned, and correct me if I've made some wrong assumptions, but my understanding, of course, is that it helps pay some of the loan interest fees, other issues, change in valuations, so that to avoid the crossover risk. But then you mentioned that at the end, when it's time to, so to speak, move out of the home, the annuity would revert to pay the ex-homeowner, and it could be used as rent. So, but I was trying to understand how that amount of annuity could actually suffice as rent, because indeed, if it's not really the principal part of the payment, because the principal was already paid off to the borrower through the capture of the equity. So is it really enough as a rent? I mean, it doesn't, I don't know, seem to me, but maybe you can explain.
Okay, so let me give it a shot. And let's imagine we live in a 14% interest rate world instead of a 2% interest rate world. It may be easier to see how that's conceivably true. Or imagine you live in Vancouver or New York, where rent is 1 or 2% of the value of the house, just to see how it could conceivably be true that this annuity could make the payment. But I'll give this a shot. You, again, think about the value of the house as two components. The value of rents while the borrower is alive and in the house, and the value of rents after, right? The present value up to they leave, that's the annuity. And then there's the proceeds to the borrower, which the most that can be is the expected value of the house when they're gone, okay? So if you think about it that way, the difference between 100% and that lump sum of cash or credit line that the borrower gets is exactly the value of an annuity that covers rent as long as the borrower's in the house. That's what we're giving in favor of the bank. The borrower gets value of the house after the part that's going to the bank, and then the borrower is exactly the value of rent every year until they're out of the house. Okay, so that annuity amount can exactly cover it, you know, in that stylized world. With risky prices, you can't quite get there, but that's the conceptual reason why that works.
And so we have one last question there in the back.
Hi, this is Pratima Damani from SP Group. I had a question for you, Stephanie. Servicing enhancements. The suggestion you made appears like a low-hanging fruit, and your experiment was pretty. I think it was the fact that you can reduce default risk by 50% is significant. What would it take for HUD to require something like this from its servicers, at least on the insured pool? Why is it that HUD cannot require such simple actions from its servicers?
I actually think Chris might be better suited to handle this as somebody that's, more experienced in the lender world. But I mean, I think some of the lenders are proactively doing these things because they know it's no-brainer. And I think we've gotten that response from some. Well, of course we do that, but there's a lot of servicers that aren't doing this. So I don't know if you want to.
I mean, I think the problem is often what HUD allows and reimburses.
Yeah.
Lenders, for the most part, that, on most legacy loans, for example, there's no reimbursement for lenders for cash for keys. There's very limited reimbursement. Up until recently, there just was a mortgagee letter that came out that, had very strict limits on the kind of repayment plans lenders could put into place, and strict rules about if the borrower in any way didn't do what they were supposed to, then, the servicer's on the hook. And so the problem is if you don't follow the HUD rules as a servicer, you then take on the risk yourself of the losses associated with that, or you face curtailment and non-full reimbursement. So in a sense, HUD is working to change some of those, but there's more, I think, there's more obvious things that can be done, and it's really a matter of, in part, what HUD allows you to do and still get, the insurance. Well, if you don't follow the rules, you lose the insurance and you lose the protection that a servicer, relies on financially to manage.
And one caveat I would say, it's not clear. So we actually had the counseling agency provide these reminders. It's not clear to me if it would be the same effect if the servicer were to provide the reminders. So it's possible that it should be, maybe HUD funds the counseling agencies to continue to do this. It's a very low cost. I forget, it was like less than $1 a person. Like the reminder intervention was super cheap. I mean, so if you were to budget something like that in and the counseling agency were to continue to send those reminders, or HUD, we automated them. So we just kind of searched to see when the property tax due dates would come due, and then we automated the reminders to go out. It wasn't a manual process. We set it in place with all 1,000 individuals from the get-go. So I think it's not clear if the servicer did it. I mean, sometimes borrowers get confused, and we were talking about this. I mean, they get a lot of mail. They may throw it away they may think somebody's trying to offer them another product. So who's the best person to give them this information, this reminder? It could be that it should be HUD or the counseling agency and not the servicer.
Yeah.
So thank you, Stephanie. Thank you, Chris. So as the clock ticks to 0, I just want to thank you all for coming today. Thank you to everyone listening at home. And please join me in thanking our distinguished panel. Thanks so much, guys.
Thanks for watching. Be sure to like and subscribe for more videos from Brookings.